Island Guy Tony here. Welcome to the Outer Banks. Today, we're going to talk about 1031 exchanges. Today, we're breaking down one of the single most powerful tools in the real estate investor's toolkit, and that is the 1031 exchange. First up, we're going to have to do some legal house cleaning. I'm a realtor, not a CPA. So before you do anything based around tax strategies, please talk to a qualified CPA. When you sell an investment property and you make money on it, usually the government wants to take a piece. It's your capital gains tax. Generally, it's around 17 to 20%, but it adjusts differently for each individual. Now, the IRS does provide you a pathway to continue to invest and to keep moving forward and to keep plugging money into the economy. Basically, you're getting like a free loan on the government's part, and they call this the 1031 exchange. Essentially, you are going to purchase a like-kind investment, and you're going to defer the tax that you would have paid on the capital gains of that property into your next property. Let's talk about how this works. Now, notice that I said defer, because you're not just not paying the tax or getting rid of it, it's just moving along with the investments as you go. You're basically kicking the can as you move into the next investment, because it's going to take up all of your profit and it's going to eat up all of the prior debt that you had before. Now, you can keep kicking this can indefinitely, basically until you die. And then at that point, if you're giving it off to heirs, it's going to go poof, and they're going to get what they call a step up in basis, which means they are now not liable for that capital gains tax because they're going to get that property at the market value right then and there. So if they sold it, there'd be no new gains for them to tax on. They can't just sell this property and go buy a yacht. Notice earlier I said like-kind investment. So let's take a deeper look at what like-kind investment means. This doesn't mean that if you own a condo, you have to just buy another condo. It just means that you're going from one investment property to the next income-producing investment property. This means you can sell your condo and you can go buy a long-term rental in a townhouse in the middle of the city. Or you can sell said townhouse and buy a short-term rental beach home somewhere along the Outer Banks. If you do, you should call me. You can go buy raw land, you can invest in commercial property like strip malls, as long as at the end point it's going to be leased or it's going to be income producing, then that is what is considered a like-kind investment. There are even some cool products out there called DSTs, or Delaware Statutory Trusts, that are like large groupings of commercial properties of different types that allow you to invest in them passively, and you don't have to deal with any active management, but we'll get into that into a later video. The only thing you really can't do is you're not going to be able to sell your primary residence, and you're not going to be able to go pick up a house, buy it, flip it in 3 months, and then sell it, and then call that return your investment. It has to be a property that is currently producing income for you. Obviously, because this is an IRS rule that was created by the government, there's going to be steps and there's going to be things that you have to do, and the one thing that most people screw up with on this is going to be the timeline. There are two very important timelines that you need to make sure you hit. The first rule, or the first one, is the 45-day rule. Now, you have up to 45 days to identify up to 3 properties that you're interested in purchasing in writing. If you wake up on day 46 and you haven't identified a property, capital gains tax. The next one is going to be the 180-day rule, which means within 180 days, you need to have closed on one of your 3 chosen properties. This is strict. Once you go past 180 days, again, capital gains tax. They want to keep you moving this money from one place to the next quickly and efficiently. The final piece of this puzzle is going to be the boot and a qualified intermediary. During this process, from the initial sale of your first investment property through the 45 days of identifying one and then 180 days to close, you are not allowed to touch any of those funds. They can't come into your own personal accounts. So you need a qualified intermediary. Now, this is going to be an escrow company or a financial institution that will hold the funds from the initial sale until you identify your properties and then you close the sale on one of said properties. Next is going to be the boot. The boot is going to be any money that you make in profit outside of this sale. So say you had $500,000 in profits from the initial sale on your initial investment property, you bought a $400,000 property with that, and you had that $100,000 remaining as profit, that's what you're going to get taxed on. Now, one way to avoid this is to go into a higher priced property or a larger investment, or you can jump into a DST or a Delaware Statutory Trust or a larger commercial investment. That's the whole purpose of the 1031 exchange, is to help people reduce their tax liability and then move into bigger investments. So to recap the whole process, you're going to sell your first initial investment property. You're going to take 45 days to identify the next 3 properties you may want to purchase. Then you're going to purchase one of those properties within 180 days. You're never going to touch the cash, and you're going to use a qualified intermediary in the meantime. Then in the end, you will have moved on from one investment to the next. You won't have paid capital gains tax, and you will have effectively used a 1031 exchange. If you have more questions, reach out. I'd love to chat about this. Also, make sure, please, this is tax advice. I'm not a CPA. Go talk to a CPA to make sure this fits within your plans. Thanks, guys. Great talking to you. See you later.